give 1 more minute. So I'm going to give a few more seconds and we will get started very shortly because we have a big agenda today. It's 12:30, so let's give participants a few more seconds. All right, 12:30, let's go. You are the right place. This is a webinar about buying a profitable business without getting burned. You don't need to have a finance experience to run an acquisition of a company, and you can do it with confidence in less than 12 months with the methodology that we're going to run. But today I am delighted to have Dr. Renée Kaddouch-Kulbach, who is a French lawyer. She has been based in Singapore and Paris. She's a specialist of cross-border transaction and a partner at Square Law. Renée, are you with us? Can you say just a few words about you, and we will run the agenda later on.
Okay. Yes, I'm here. Nice to meet you all. And like Agnès say, I've been a lawyer since 2003, so more than 22 years now. And since then, I'm specialized in M&A, domestic and cross-border transactions. And earlier this morning, one of my former clients consulted me for a problem in Singapore and in Australia.
Fantastic. So you can go very far to close a transaction, Renée. So let me walk you through the agenda of today because it's very dense. First, we are going to run a short presentation of ourselves. We will see also why you're attending this webinar. I will walk you through the 6 good reasons to buy a business and then the success recipe, how to run your search with the PE discipline. We will navigate with Renée the transaction timeline. She will address your main fears about your transaction with a list of questions. What if something happens? We will see how to adapt your financing structure because this is key to understand where you are standing in terms of valuation cycles. We will go through the 5 bad reasons stopping you from taking action. Shortly, we will go through technology and how can this boost the PE methodology in 2026. And we will go through my complete program before opening up with a Q&A session. But first, who are we? So my name is Agnès Hugo. I have about 20 years in the private equity sector and 10 years running operation as a CEO. I might have deployed over 2 billion euros of financing and analyzed more than 500 transactions. My business journey started at HEC Paris. Then I joined a big audit network, which was Coopers & Lybrand at that time. Switched to Ernst & Young. I became a certified public accountant in the US, but I really wanted to join the financing world. So I took my MBA at INSEAD and I was accepted at Apax, which was one of the most ancient investment team in Paris. Started my career as an investor, restructuring management buyouts. And that gave me tough lessons about what is a financing structure and how, to avoid being trapped into debt repayments. I wanted to have a European exposure, so I went to work for Landsbanki in London. From London, we used to finance acquisitions all across Europe and even in the US in all sorts of sectors. We even financed a website, a private school, ESG, and all sorts of B2B companies and distribution in the distribution sectors. But in 2008 came the financial crisis. It was a very tough time. A lot of banks went bust. My bank went bust. And I saw a very big opportunity in developing the secondary approach for private debt because it was authorized in France. So I raised a search fund, was backed by two private equity investors, doing mezzanine and private investments, Capzanine and 123 Ventures. But for regulatory reasons, we couldn't deploy the money. And I switched to Alvarez and Marsal, which was running off the assets of Lehman Brothers all over the world. That was also a tough time. They sent me to Greece, where the financial crisis started to kick off. This is where I've done M&A of banks. The large subsidiaries of Crédit Agricole and Société Générale were sold for a negative price. I also created Cité Gestion, which was a project dealing with financial toxic products sold to municipalities. So by now, you can tell that I have touched upon any kind of financing. But in 2015, I had my son and we decided to move to Singapore, where I started from scratch a digital platform, Fast Track Trade, which was dedicated to finance SMEs. We were backed by Prudential and a large Commonwealth trade association based in London. And this is why we were invited at a roundtable with Prime Minister Theresa May, who was in the middle of Brexit. And we explained the mechanism of platforms like Alibaba or financial lands that could really help develop the economic trade. So from there, I explained this mechanism at key European institutions like OECD, the WTO, the International Chamber of Commerce. The last photo, I really liked it because it was taken in Laos, where we explained the process of fast track trade. For personal reason, I had to go back to France 6 months before COVID happened. I settled down in Station F. Please, could you shut down your Mac because we can hear you. And after the COVID started to put everyone at home, I looked for a job. I was given a job in a real estate group as a deputy CEO.
I got your back.
And I had to run a very severe cyber attack that we countered using, again, a platform mechanism to push all the components to a large network of servers and computers. But I run this operation in a very deteriorated way, and I had to step out. I was completely worn out. So I started to reflect on what I really liked, and working with SMEs and management teams always fascinated me because I truly think this is where entrepreneurship happens. And I have more than 20 years of experience. So I used to teach LBO structuring in traditional finance programs like at HEC Paris or Schema. I also participated at INSEAD sessions during the first 100 days post-acquisition. And I realized that there was a lot of value in backing management buy-in candidates. So my mission today is to help 20 ambitious leaders buy their first company in 2026, and they will get tailored coaching. Can you please turn down your mic because we can hear you while I am going through the presentation. Sorry, thanks. So during that support program, they can learn how to buy a company at their own pace. And also they will have access to tech tools with tech partners and how to use platform mechanisms to organize their reach out campaign to business owners. This is an article about Alois, published by Decider magazine. We published a lot of things on social media at Fast Track Trade on X and LinkedIn. You can find a lot of things about me. In everyday life, I am based in Paris. My son is now 12 years old, and I love diving and skiing. So we have other topics to discuss during your acquisition process. But now let me open the floor to Renée Kaddouch-Kulbach, who is going to explain her deep experience in M&A transactions. Renée, the floor is yours.
Thank you, and yes, thank you for the introduction. Well, like I said, I've been a lawyer since 2003, and since then I work in M&A field, both domestic and transaction and cross borders. So I have I work mainly in small and mid-cap transactions, but at the very beginning of my career, I was trained in big international firms where I worked on larger transactions, but quite frankly, not anymore. And I also work in private equity and venture capital field, which is pretty close of M&A, but my main area of expertise is M&A. In late 2012, I moved to Singapore when I launched a business, a legal business, in respect of cross-border M&A between France and Southeast Asia and venture capital. And like many others, due to COVID, I decided to move back in France in mid-2021. So next month, it will be 5 years since I was back in France, and I joined my current firm as a partner in early 2022.
So fantastic. So effectively, I thought it would be super interesting for MBI candidates to have your experience because you have supported buyers and sellers throughout, cross-border deals or local deals in France. So now let's go to you, participants. Why are you attending this webinar? Clearly, this is because you want to create value for yourself. You want to take control of your future. You have spent years building your expertise, and you want to put it to work for yourself, not just for someone else. You dream of becoming a real leader, not just changing jobs, and you want purpose, autonomy, and the chance to build something meaningful. You've seen business owners your age. They bought a company and were successful, so you know you can do it too. Because if it's not now, when? Life is too short to keep waiting for the stars to align. And if you ever dreamed of being your own boss, now it's the right time to explore it. But you want a method, not just motivation. You don't want only just believe in yourself approach. So this webinar, it's exactly about a clear roadmap, the right tools, and examples of people who have done it before you. But you don't have any finance background, and this is what has been holding you back. We will see later how you can be definitely supported on this. You're worried it might be too late or too risky. It is not. In fact, we are facing a once-in-a-generation opportunity right now because of the baby boomers having, to pass the ball in their company to their successors. Let's see the 6 good reasons to buy a company right now. It is definitely for you if you are an executive between 35 and 60 years old. You know a sector or a function pretty well, and you want to take over a company in that sector. You just left your job, or you know it's going to be retrenched soon, and you really want to buy a company, a small one, with EBITDA between 1 million to 5 million alone or with a partner. This webinar is also for you if you have always dreamt to run a business and to grow a company, but you have no background in finance nor in M&A. Or you might want to grow the family business, but you have never done any acquisition before, so you need a method to be successful. So this is my commitment today. I'm fully committed to guiding you step by step through the same simple proven method I used to buy and finance businesses when I was working in the private equity. And this is really where I got my finance background on the ground. And by the end of this webinar, you'll have a clear understanding of how you too can acquire a company and run a small business. This is not just theory, it's a practical roadmap designed to give you clarity, strength, and momentum throughout your acquisition journey. And why do I do this? Because I believe that becoming a business owner shouldn't be reserved for elite investors or finance experts. After 20 years in private equity, I saw too many talented professionals with leadership potential miss out just because no one explained them the tools. And stay up to the end of this conference because this can change your life and we have something to share with you. So now let's go through the success recipe. If you want to be successful, you need to run your search like a PE investor. And this is just like running a marathon. You need a discipline, a proper discipline to be a finisher. So first, you need to own your deal flow and you need to create a multi-channel approach because you never know where the good project is going to come from. And nowadays, it's beyond the traditional way to be connected with, local accountants or M&A advisors, because you're going to find online listing platforms where there is a real sharing of projects to change hands. You, of course, can access your professional network, and you need to extend that to alumni, to lawyers, to certified public accountants. You can also participate in investors and professional clubs, but there is a much more efficient way, which is going to use platform channels like LinkedIn and automate a direct outreach to owners with the CRM tools that we can all use. This is going to create a qualified opportunity deal flow that you're going to own. And this is very important that you are on all the radars, because you need to be known at the beginning of your search by all the players who can participate with you in buying a company with you. So we need to deal with mezzanine players. You need to deal with platforms. You need to deal, of course, with M&A advisors and boutiques, but also headhunters who are recruiting for PE firms, because these guys are aware of a lot of targets that need a CEO, and you need to be visible on every radar. But you also need to own your deal flow. That is to say, a PE firm will just focus on the number one or the number two of a sector. But since you are focusing on the larger tail with small players, I mean, you really want to create your own active deal flow that will come to you even after a couple of months after starting your search. And you need to go for these hidden acquisition targets, which looks like an iceberg, because more or less 60% of businesses needing successions have not done any preparation, and they are not visible on the M&A market. So you really want to reach out to these business owners before they get started to think about their successions, or before even it is too late when they have an accident in life. This is a video about a business owner who explained what was the process used with him. And effectively, I'm not going to run the video because we have a lot to go through today, but everything started with his key employees not being able to pay for the shares of the company. And then he received a phone call, a random phone call that initially he thought was a spam. And this is how everything started. A phone call, curiosity, you want to meet with the potential buyer, and then these business owners get into a succession process. So step 2, it's also super important as part of the PE discipline. You need to screen and select your deal flow. And it's a statistical game. That is to say, out of 100 opportunities, only 10 will be analyzed by a PE investor, and they will only close one. And besides having this statistical approach, your probability of chances to close a deal are very limited. Then there are top 5 business metrics that you need to check, and you don't need to be a finance specialist to find them. First, the sales and the trend over 5 years, the EBITDA and the EBITDA margin, the evolution of sales and the number of clients to see whether the business is dynamic, the year-end cash, because that shows a profitable business that has built up a pile of cash, and also the taxes that are paid, because definitely when you pay taxes, you have not been able to avoid them. Then that step is also critical. That is to say, you need to focus, reassess, and iterate your interest with someone who is external. That is to say, either an investment committee or external experts, because you will be provided with data going on, and you definitely need to reassess whether the deal is pertinent for you. Then you need to make offers, because before you send an LOI, nobody is going to open either the site, the production site, or to have a direct discussion with the business owner. And it's going to be without hesitation, because you're going to put a lot of conditions before being able to close a deal. Then you will have to structure smart capital beyond traditional financing, because when it comes to SMEs, it's official that banks sometimes cannot provide the financing. And there are so many ways nowadays to go and find alternative financing, either through private debts, family offices, asset-backed lenders, minority PE, or pure PE players. And you want to understand with whom you can play the best. Now, let me open the floor to Renée, because I asked her a few questions about how to navigate the transaction timeline that is more or less going to be this one for every MBI searcher. Renée, it's yours.
Thank you, Agnès. So you need to be very, very disciplined, like a PE fund, in every step of the transaction, from phase 1 to phase 6. Phase 1, you need to select advisors, financial advisors, coaches, and so on and so forth. And also, it can be useful to engage a lawyer at this stage, not, of course, to structure the transaction itself, because it's way too early, but at least to help you structure your investment. May I set up a company? May I not? What are the tax implications and so on? So it can be useful to engage a lawyer to assist you from phase 1 onwards. Phase 2, you follow your deal flow, you meet your counterparts. At this point, you need to sign confidentiality agreements, reciprocal most of the time. So you commit not to disclose anything, but also the targets will commit not to disclose anything about you or in your discussion. And then you continue. Phase 3, if you want to move forward, you need to sign what we call a letter of intent, LOI. You declare you want to move forward and, okay, let's move on together and let's see. At this point, you really, really need to engage a lawyer just to be aligned on key terms, and not only on financial key terms, but also on legal key terms. And we will discuss it during the what if phase of the webinar, but you need to define the legal issues. And what if you want to set up the seller want to set up a new business right after closing? You need to settle this issue and so on. And this must be settled at this stage, even if it is not binding. Okay, so you both parties have signed a letter of intent. Then the phase 4 of the process is open, and this is the due diligence process. At this point, you will check if everything your counterpart told you is accurate. The due diligence is, of course, technical, financial. This is the key issue. Legal, also, you need to check out the corporate structure of the selling company. You need to check out the employment, the tax, and so on and so on. You also need, and this is more and more important these days, you need to check the information system to make sure that the IT system of the company is not vulnerable. And during this phase, you start discussing what we call an SPA, a share purchase agreement. Then, in between phase 4 and phase 5, you negotiate the legal document. And this is globally the end of the process, but this is the most crucial step. because at the end, either you find an understanding and you close the deal, or you are not. Agnès, could you please move back? Thank you. And phase 6, so the SPA is structured between two phases. Signing, you sign the agreement, and then closing, you close the deal. So phase 6, between signing and closing, you fulfill or waive, that the case may be, the condition precedent. And then you close the deal, and then you drink champagne.
Hopefully. But what if a few things happen? And this is a list of questions that are part of the main fears of someone who is buying a company. So I'm going to ask them one by one, Renée. What if the financials are wrong?
Well, buyers do not acquire a set of accounts. They acquire business based on such accounts. And if the financial information later proves inaccurate because of an undisclosed liability or an accounting or tax issue, the buyer needs a contractual mechanism to recover the loss. This is the role of the representation and warranty. This is one of the key points of the whole legal process, is to provide robust reps and warranties to the benefit of the purchaser, of the buyer.
And can you explain a bit how we can leave some money in an escrow account before the final price is fully paid?
So this escrow account provides an additional layer of protection by ensuring that part of the purchase price remains available if a claim arises after closing. So this escrow mechanism lasts between 2 years, depending on the duration of the guarantees, of the reps, of the warranties, but it is released if after the warranty period, nothing has happened.
So that helps protecting anything that can be found out once the buyer steps in.
Exactly.
So what if key staff leaves?
So in many businesses, the real value sits with a handful of individuals who hold customer relationship or technical expertise or operational know-how, you name it. And if those key individuals leave shortly after closing, value can disappear far more quickly than any financial model anticipated. So we fix this issue by entering into what we call, sorry for the legal jargon, bonus retention agreements. The objective of such agreement is not simply to keep key employees, it is to preserve the continuity of the business after closing. And lately, I worked in the acquisition of a veterinary imaging company by an international industry group, and the retention bonus, because one of the employees was key to the continuation of the business. So we provided a retention bonus agreement, and such retention bonus was structured around 3 key principles: a fixed retention payment spread over several years, a forfeiture of unpaid amount if the key employee leave voluntarily before the end of the retention period, and acceleration provision under which all outstanding payment became immediately payable. For example, the sale of the business, a change of control, a termination of the employment agreement without cause, and so on, or death, or whatever, you name it. And in addition to the retention bonus agreement, and we did so in this transaction, a specific reps and representation and warranties is often provided in this respect, whereby the seller represents and warrants that, to her best knowledge, no key employee will leave as a consequence of the transaction. So basically, there are two layers of protection. First, a retention bonus agreement, and second, a specific representation and warranties to address this concern.
So now, what if the seller competes with me after he sold me his business?
Basically, there are two ways to protect, to address this concern. First, it's imperative to properly draft a non-compete clause to protect the value that you have just acquired. And of course, there are specific conditions. So you need to take super care when you provide this non-compete clause. It is not always valid. It can be null and void. So you need to take super care. It must be calibrated in terms of duration or scope of activities and geography. First layer, non-compete clause. But you also need to provide an equally important layer of protection called a non-solicitation clause. Such clause prevents the seller from targeting key customers or employees after closing, even for non-competing business.
Now,
for example, yes,
sorry,
go ahead.
No.
In this transaction, in the veterinary imaging business I just told about, let's imagine that the founder, the seller, subsequently launches a veterinary software company. Technically, it is not competing. But however, we provided a non-solicitation clause to prohibit the founder to contact former customers of the sold business to promote the new venture, because otherwise the buyer could lose valuable commercial opportunities that form part of the rationale of the acquisition. So basically, yet again, two layers of protection. First, a non-compete undertaking, and two, a non-solicitation undertaking vis-à-vis customers or vis-à-vis employees.
This is clear. Fantastic. But what if now working capital is lower at closing? We have less cash than what we had anticipated.
For a long time, we provided what we call working capital adjustment clause. And such adjustment helps ensure that the company is delivered with the level of liquidity required to operate in the ordinary course of business. I used to do it a long time ago, because the market practice has changed. But a long time ago, in one transaction, we provided that the parties agree on a target level on working capital based on the historical operating needs of the business. So the seller provided an estimate shortly before closing, and the purchase price was calculated accordingly. And we provided that following the closing, the buyer prepared closing accounts to determine the actual level of working capital. So it could take months and months of discussion of the accounts. So the practice has changed, and now we provide what we call lockbox. And pursuant to a lockbox, instead of adjusting the price after closing, the parties agree that the price upfront, based on historical accounts at a reference date, and the seller undertakes not to extract value from the business before closing. The logic is pretty similar to interim covenants. We will talk about it later, but interim covenant protect the buyer against adverse actions between signing and closing, and a lockbox applies the same philosophy, the same spirit to the period between the lockbox dates, the date of the latest, the most recent account, and the closing.
Okay, and now, what if there are hidden liabilities that the buyer become aware of, but 6 months after closing the deal?
So this is the second part, if I may say so. If this is the second part of the reps and warranties mechanism. First, you provide a list of representation and warranties on a quite complete set of issues, say existence of the company, existence of the business, regular employment, tax, and so on. And then if such representation and warranties are inaccurate or are misrepresentation, the seller undertakes to pay an indemnity to the buyer. So this indemnity regime allocates the risk you described between buyer and seller.
And to make sure that the seller will pay it, shall we keep an amount in a lock box
into escrow?
Into an escrow account.
Into okay. Escrow, and in larger transactions, representation, we provide that the warranty of the warranties is given by an insurance company.
Okay. So there will be a third party that will pay on behalf of the seller the amount that will be claimed by the buyer.
Exactly. Either an escrow, most of the time a lawyer, it can be a bank, but most often it's a lawyer, the lawyer of either party. In Paris, it can be the bâtonnier of Barreau de Paris, sort of CEO of Paris Bar. It's highly regulated, so there is no risks. We sign an escrow letter, and the amount can be released only when it is provided by this escrow agreement. So it is pretty secure. And more, and especially in larger transactions, we provide, instead of this warranty of the warranties, we provide an insurance instead of the escrow. But it can be costly, especially for the insurance company, because they need, before accepting to insure this risk, they need to make a further due diligence. So it can delay the closing.
Okay. And now there is a question that is obvious to everyone. What if I paid too much?
Oh, so I just talk about one of the key issues of the transaction, which is the reps and warranties mechanism. And the second key issue of the whole transaction is this question: what if I paid too much? Because money in an M&A transaction is everything. So what we provide to address this concern is what we call an earn-out mechanism. And this earn-out is the most effective way to bridge the valuation gap. And rather than debating forecast indefinitely, the parties agree that part of the purchase price will depend on future performance. And as a buyer, the most important thing you have to think of is to keep leverage on the metrics, the earnout is based on financial metrics such as turnover or more and more often EBITDA. And as a buyer, you need to keep leverage to reduce the metrics and to avoid, if I may say so, to avoid pay the earnout and to stay within the contract limit. So when you do that, you are acting legally. Because once you buy the company, you control the business. So it can be easy. And I advise, like Agnes said, both sellers and buyers, depending on the transaction. And I know all the traps made by the seller to make the earnout mechanism as dependent as possible on the performance. So I know all the leverage. So it can be easy. It's a very good thing to advise both sellers and purchasers so that I can know the trap and identify what my counterpart, the counsel of the seller has done. And I say, okay, great, he didn't do that, so it is good for us. Let's move on and let's sign this deal.
Let's keep it. So now, what if the seller leaves with all the company data? And this is not just a dream, it can become your worst nightmare.
So to address this concern, the most important thing is to provide a confidentiality undertaking from the seller. And such confidentiality undertaking must clearly define what information may be retained, used, or disclosed by the seller. Of course, and it is the case in the whole process, but you need to bear in mind that the confidentiality undertaking is more than a powerful deterrent than a real legal protection, because it's super complicated to enforce.
Yeah, definitely. So now, what if there is a change of control? What happens with the main contracts of the company, and how to make sure that nothing will fall apart?
So this is very easy. During the due diligence phase, you carry out a legal due diligence, and during this process, you review all the contract, the commercial contract, the financial contract of the target company, and you will review all the change of control provision, providing that in case of a change of control, in case of a sale transaction, the agreement can be terminated, and sometimes with fees. So if there is such a contract, you provide a condition precedent in this respect, pursuant to which the contracting party waive this provision, waive this change of control provision. And also you provide representation and warranties in this respect, pursuant to which the seller represents and warrants to you that, except for what you have found out in the due diligence, there is no change of control provision in any agreements of the company. This is standard.
And now there is an even worse question to ask yourself. What if there is no contract? That can happen on both the client side and the supply side.
It happens to me once, not in an M&A transaction, but in a venture capital transaction. I advised an investor to review the legal documentation, and he told me, "Oh, but the founder showed me the commercial pipes. There are a lot of prospects. There are an important turnover for the coming months. The forecasts are good." And he told me there was agreement. Can you review them? Of course. And I found out there there was no contract. There was only letter of intent, which are not, like you say, like I said, binding agreements. So the agreement can be stopped immediately. So there won't be any forecast. So of course, I called my client. They say, "Oh, Houston, we have a problem. There are no contracts." And he said, "Okay, thank you very much." And at the end of the day, he renegotiated the valuation of the whole company, and he got more shares for the same investment amount. So it was in 2017, 9 years later, we still work together.
And now, during the time where you sign the documents and the new buyer steps in, what if the seller runs the business into the ground before closing?
So this is to address this concern. There is something very, very standard to do. It's to provide what we call interim covenants. The seller undertake not to carry out some particular transaction, and of course you need to list this transaction without the buyer prior approval. So these interim covenants are designed to preserve the target company during this period between signing and closing by requiring the business basically to operate in the ordinary course of business.
And this is not, a far-fetched risk, because right now we have so many artifacts of wars or change in tariffs. We had that over the last 12 months, that you need to be aware that a business can be super changed because of this happening. And it's reality. That is to say, when the 9/11 event happened, I remember we were working on a transaction in the air service industry. So before the 9/11, the business was worth 12 times EBITDA. After the 9/11, it was worth nothing. So you really need to know how to to get out of a transaction that has been negotiated, because the whole environment has completely changed, and your business is not flying anymore. But you need to be aware of that. That is to say, always introduce a MAC clause of some sort, and
Exactly.
the banks are super good at doing that. So you can also use the MAC clause in a banking agreement, financing agreement, so that you can get out of a deal when the environment is not the same.
And but I recently negotiated a MAC clause in my latest transaction, and we harshly negotiated it because it is in the tech business, so the price of energy can have implications. So I was advising the seller, so I took extra care of to exclude external factors from the MAC clause.
And that's super, super key. Now, another key question also is when there is a real estate contract between the company operating in a specific site with an external party. So what if there is a real estate contract with the business, and what do we do with it? How do we make sure that we can still use and that the price will not change just because there is a change of ownership?
We, as buyer, you need to verify, you need to check if that the target company can continue operating from its existing premises after closing, and that no hidden restriction threaten business continuity. So you need to check during the due diligence phase if there is any restriction, and if so, you need to provide in as condition precedent, the same as you do with change of control. You need to provide, the approval of the
landlord.
The landlord. Thank you, Agnès.
Yeah, definitely. And this is a big risk or when you're looking at restaurant business or a company operating from a specific site because you want to make sure that after the change of ownership, the landlord is not going to have the idea to increase the rent paid by the company by 25 or sometimes double it. And this is a real threat to maintaining the profitability level of the company. So now,
I was about to give just an example. When I was in Singapore, and yes, I worked for a buyer, and there was an issue with a landlord, and basically this situation, and we provided as a CP the approval of the landlord. And you know how the landlord in Singapore are,
yes,
they are
super tough.
super tough at negotiating the rent prices. And at the end of the day, we closed the deal, but my God,
It's
it was the most important issue of the whole transaction.
And I agree with you. I mean, sometimes dealing with a landlord can be super tricky, and that can jeopardize completely the profitability level of your company. So now, do you have any other questions relating to your transaction? So if yes, write them in the chat. We definitely want to cover them, and we can cover them in the Q&A session a bit later on. So do not hesitate to write your questions in the chat. Now, thank you, Rene, for all of this game. What if bad things happen? Now, let's go to the next part, which is about adapting your financing structure. And I would really like to highlight this key element, that is to say, the cyclical nature of valuations and what that means for your deals. Because if you're not aware of this cyclicity of value and of multiples, you might end up buying at too high a multiple and then, being uh, getting an exit and making, a gain for yourself quite difficult a few years down the line. You can see here all the PE investors who have invested in the years, they call that vintage 2021, 2022. I mean, they have bought companies at a much higher multiple than what is existing right now in 2025. And that means that mechanically, what they paid for 5 years ago is much lower right now for the same business. And you need to be aware of that cycle issue when you buy a company and what kind of sort of liquidity consequences this will trigger, because in 2020, 2021, there was a large liquidity available on the market, but this is not the case anymore, meaning it's going to be more difficult to find financing and it's going to be less cheap than 4 years ago. What is a financing structure? In fact, it's just like a rocket. So essentially, the closer you are to the floor, the lowest the risk, and that's going to trigger lower margins, like for tranche A, between 2 and 4% above the rate of Euribor in Europe. And when you go higher, you go to the second floor, you're going to be further to the assets of the company. So that means that you're going to require a much higher return, typically between 5 or to 10%, depending on the period. And then the third floor will be mezzanine, so equity-like component, but it's not shares. So you will request a higher interest rate versus second lien, but lower than equity. And when you are at the equity layer, this is where you take all the risks, because usually when things go wrong, the equity layer is completely swallowed, disappeared, and that's the creditors who take over the business and the remaining value of the business. So this is how we consider a financing structure, which means you need to be accustomed to read a sources and uses table. You will find that in every single transaction when you need to have multiple layers of financing. And here you can see on the left the sources, term A, which is repaid over 6 to 7 years, term B, which is repaid in bullet, term C and D, which are, uh, repaid later, 9 years, 10 years sometimes. That's going to be the financing facilities. On the top, you can put a mezzanine facility. Usually, it's going to be below 1 to 1.5 times EBITDA. And then the rest will be the equity. So guess what? This is a highly leveraged deal right now with only 25% of the equity versus the total value of the deal. And in face of that, that will be used to pay the price of the shares to the owner. You will also refinance the existing debt because most bankers like to have a deal free of debt or free of cash. You will also pay the transaction costs. So all the costs that are directly linked to the transaction, like the due diligence, like the preparation costs, so including your lawyers, including your financial due diligence, that will be covered by the pool of the financiers, not only the equity players. And there might be a little excess of cash over funding that you will keep, because the nothing is super precise, and you might need a bit more working capital element. Then you will put that into a financial model that every financiers would request. They are standardized. Each bank has its standard format, but from there, you will definitely have the same ratios comparing the capability of the company to repay the debt service, and the total leverage out of EBITDA. So you can see the total senior debt to EBITDA ratio, the total debt. We also follow the fixed charge cover ratio. That is to say, this needs to be higher than 1.2 to make sure that the company is viable. Of course, you will come up with a business plan, but you will have 3 cases. So the base case that you will see, and this is the management case. You will have a downside case to see how well the company can keep going if there is a stress in its operations. And the optimistic or growth case that you will keep for yourself, because this is really your equity game, because you want to extract value from the value creation plan that you will introduce. Now, let's go through this case. It's going to show you how Marc-Antoine de Minibus took over Hendrik in 2024. The first thing that he did was to make sure that his wife was on board, because definitely if you have some stress from your family, you will never achieve any closing. Then he defined his life project, happy to move to a different region, and he focused on specific sectors because his background was in the food and agribusiness, but he was happy also to look at packaging and chemicals. He also targeted a specific size between 1 to 10 million euros in terms of sales. And effectively, he only had to send 2 LOIs. The first one, the company went to a corporate buyer with a much higher price than his. But the second, it was Hendrik. We're not going to see the movie, but it's a very nice company based in Rhône-Alpes. So if Marc turned out to successfully buy a business following this method, then you too can do it. Question, can this work for you as well? Or what might be missing in your case? I'm super curious to know about this. Please write this in the chat and we will address that, your question later on in the Q&A session. Now, let's see quickly the 5 bad reasons stopping you from taking action. You're going to see that it's not risky to buy a business that has been run for years. It's less risky than to create a company. You have no clue in finance, so to speak. The finance aspects are easy to understand, and then you will have legal advisors and finance advisors to back the analysis of the business. There are not many good targets. In fact, we are facing this baby boom with a lot of successions happening. My professional network is limited. We have seen that it's not only with your professional network that you're going to generate a deal flow. And I do not have sufficient financing to make an offer. We've seen that you can definitely have financial partners coming to your deal. So all of this, you can forget about it. And let's see now how technology can boost this PE method drastically. That you can definitely use now targeted sectors. Can you give me just 1 second? Sorry, someone was knocking at the door. You can automate your business intelligence search. You can compare and signal competitors' new trends. AI copilots can do that for you. You can also create a database out of PDF documents because AI agents can read PDF documents and can organize a table for you. You can automate target search campaigns using a CRM. You can automate business owners' outreach. You can also obtain summaries of a very good quality for large documents on market, financial risks analysis. You can also prepare presentation documents for you. This presentation was not done with Gamma, but if you inject it into a Gamma, you will have a very nice presentation that you can address to your banks or financiers, and so on and so on. So nowadays, you don't work by yourself. You can definitely be supported by AI copilots. I'm going to go through quickly, and your goal is really to contact, fit, or quit. And you can definitely access a few technology tools to organize all of that, using definitely LinkedIn, opening your Perplexity Comet AI agent to scroll for you. And once you have you know how to do it, it's super powerful. You can also access a CRM to push campaigns because you don't need to write every single email. You can definitely automate this outreach and so on, using these AI tools. So now, are you convinced to increase your chances of success in applying the private equity method, boosted by tech tools and adapted to the SME sector? Are you ready to jump right away into your search with this tech-enhanced methodology? Are you in the starting blocks to start your project right now? Remember why you're attending this event today. It's because you truly desire to run a company and to create value for yourself and for the business. Since this is what you want, let me introduce you my program, which is really designed to help you access a transaction in less than 12 months. There is a support desk, the PE methodology, and AI power. You will never work by yourself. You will definitely be supported by experts like Rene. You will work on your own project. You will define your strategy upfront alongside seasoned professionals and at your own pace. You will generate, analyze, and validate targets that match your project, just like a professional investor. You will learn how to make an offer on a target that fits your goal while mastering the full acquisition process and being in control of the risks. In just 3 months, you will have the confidence to make your first offer. And in less than 12 months, you can have the confidence and the process to close your transaction. So now, what's the best approach to buy a business? Is this to going solo or getting expert support? Is it to work by yourself or being accompanied by professional investors? And imagine the impact that will have on your motivation as the months go by, because this is definitely a marathon. So now you are at a crossroad. Don't let this don't let this opportunity and think backwards. I could have chosen the right path, but I simply decided not to do anything. So if you're convinced that getting the right support will boost your chances of success, if you're ready to bet on yourself with a small upfront investment, if you believe this is your moment and you're ready to take control and start implementing the methodology today, if you have answered yes to all of these questions, let's move on. If you have not, then you're not ready. That's okay. You need to think about it again. But for all of us who are ready, who really want to buy a business, imagine the value that this method can have in terms of saving precious time, selecting the right businesses, getting right to answer the essential questions, not to be burned in an acquisition, and keep your momentum and see it through to the end. So if you're confident in your project and you want to have a preliminary feedback, reserve your spot now and take the first step toward buying a business. You can book a call with us. This is my Calendly direct access, or you can email Renée for any kind of questions you might have or on a current transaction you're pursuing. Do not hesitate to do that. This is key that you start talking to professionals. You can also access more added value webinars, podcasts, and be connected to a very dynamic WhatsApp community, joining this CEO ETA WhatsApp community. You have the link, but now I'm going to open up a question and answer session. So feel free to ask any questions you have to Renée or myself. This is your time. Youssef, are you still with us?
Very much so.
Uh,
Yes, I'm actually digesting everything as you're speaking. Very relevant to my case, as you know, Agnes.
Fantastic. So, Youssef,
Yeah.
you have the floor. Just ask the question
Mm,
about this earnout. I mean, do you want to have an
yeah,
earnout that is not financed?
yeah. I mean, it's something that I would love to. Yes, definitely. Based on my situation, as you all know, um, if it can be done, if the seller accepts it, then yes, I definitely would love to have an earnout. It makes more sense.
So, René, now, how would you protect the earnout on a business? Because you are not really sure that the profitability level will stay.
Yeah,
And Youssef is happy to pay an earnout to the vendor, but he doesn't want, he really wants to be protected in a case uh, downside scenario happens and
yeah.
the business does not
That's
create cash.
that's the dilemma between me and the uh, buyer.
So what you need to make sure is you keep leverage. For example, the from a seller standpoint, the say EBITDA must be broadly defined. The EBITDA must be retreated with many exclusion so that the profitability of the company is not dependent on the will of the buyer. And oppositely, as a purchaser, as a buyer, you want to keep as a definition of EBITDA as narrow as possible with less and less retreatment. For example, you can impose some investment, you can impose expenses to the company, and so on. It will reduce EBITDA, and then you avoid uh, paying the earnout. There are plenty of mechanisms to
Yeah.
make sure you keep leverage. But of course, it depends. It is made on a case by case basis.
Hello?
Hello? Yes, can you hear me?
Yeah,
Yeah, you got no. I really, because line got caught. Can you please repeat? Yeah.
It's complicated to give a general rule because of course it depends on the transaction itself. But as if your earnout is based on EBITDA, you need to provide leverage to include some expenses in the EBITDA so that the earnout is reduced accordingly.
Mm-hmm.
The key issue as a buyer is to keep leverage on the EBITDA, on the metrics, generally speaking.
Mm-hmm.
yeah, and this is why if you have a growth
Just trying to
case,
understand.
Youssef, if you have a growth case, it's okay to share the growth created between the seller and the company, what's left in the company. But if there is
Mm-hmm.
little growth, you're not going to add any financial burden because you have to pay an earnout and you committed to an earnout without um, the point of adjustment being a lower EBITDA.
Lower EBITDA.
Because you can face a situation where your EBITDA doubles. Fantastic. You can definitely share 20%, 30% of the EBITDA with the previous owner and you keep the rest to keep growing the company.
Mm-hmm.
But if you have, a very flat EBITDA or the EBITDA goes down
Go
to
down.
50%, there is no way you're going to pay an earnout to the seller, right?
Yeah. And so what the lady was saying that that's why I have to have leverage on EBITDA. And I was trying to understand what that, in this respect, the term leverage meant. Can you hear me?
Yeah, Rene,
Yes.
when you were saying to
Renee,
leverage the EBITDA,
leverage the EBITDA.
It's not very moral, if I may say so, but having leverage of EBITDA is being able to reduce the EBITDA so that you avoid paying earnouts without being in breach with the contract. You apply the contracts, you reduce the EBITDA, but you are within your rights. It depends on how it is negotiated.
so you put all the expenses, you put a lot of expenses inside.
Yes, exactly. You provide management fees.
Okay. We have a separate discussion on how we can do that.
All right,
It's not very moral, but it is legal.
Teach me how to do these things.
You're in control. You will be in control of the business, right? Afterwards. So you can you can definitely think about some kind of expenses to develop, and I mean that's going to reduce the EBITDA. And this is also what the vendor needs to understand, that he will have no control at all about the type of expenses that will go through the P&L of the business after he's out, right? So it's a game.
Let me tell you a story, Youssef, of a friend of mine. The story happened before we even met, but he sold his first company 10 years ago or 11 years ago. And there was an earnout in the transaction. And right after closing, it was a very specific business. And right after closing, the buyer changed the rule of invoicing, the accounting method, internal accounting methods, and such change had a lot of impact on EBITDA. And at the end of the day, he didn't have his earnout, and he was super angry even now. And now he's very successful in his business, but he's super angry. And he told me, recently, let me tell you something. If I sell my current company now, I will never, ever accept an earnout.
Okay, I got it.
And he could do nothing because the purchaser actually just applied the contract.
Yeah, it's all in the legal contract.
Exactly.
It's all in the definition, and it's all in the hands of the buyer, right? Because after that, he can decide to manipulate the accounts, or he can decide to add more expenses so that the EBITDA would fall, right? But thinking differently, for me, it's more like sharing the value created and obtaining the value. Obtaining the value that is embedded in the business plan, because you're going to see some business plans made up by the vendor and it is M&A advisors. Sometimes you have a hockey stick. So essentially, okay, if we realize the EBITDA next year, which is going to grow by 40%, I'm happy to have to share an earnout. And in that case, if this is created with the operations, happy to share. If it's not there, then the earnout falls down to zero. And it's a bit a way to capture the projections and the game of the seller, to show that his business will keep growing, which when sometimes it's not the case. I have another tricky question for Rene, which is more like we have to pay an earnout, but then essentially there is a reps and warranty request. So and we have a vendor loan. So in one of these big transactions, what we did was to block the payment of the vendor loan, which was due 2 years after the transaction took place, in order to compensate under bracket, because the amount that we requested was huge, to compensate what we had to pay to the seller in the contract. And you can think about that like a negotiation. If something wrong really happens to the business after you steps in, you need to have different elements to put in front of the seller to compensate your losses. And think about it, when you have vendor loan, well, it's due, but if you have something to request under the reps and warranties, that can be applied against the amount that you owe the seller. And same thing for the earnout. I mean, it's a bit like having three elements to play with that can be definitely due and paid, or that can help you, compensate for something that you have overpaid or a loss in the operations that you have not anticipated. And you can use that.
The clause.
But of course, it must be provided by the contract, otherwise you cannot.
Yeah. Let me go through if you have questions here. Well, I don't see any more questions, but if you want to have direct discussions with Renée, feel free to reach out to her. You have her email address. And let me thank you for attending this webinar. Let me thank Renée for being our guest speaker today. Thank you, Renée. And I hope you have a nice lunch. You still have a 15 minutes break before 2 p.m. Thank you, everyone.
Thank you.
Thank you.
Bye-bye.
Bye.
Bye.